I want to talk today about capital gains and the tax implications that come with capital gains, what they are, and then a couple strategies that may help you actually reduce your capital gains tax. Now, capital gain simply occurs when you sell an asset for more than what you purchased it for. And if you sell an asset for more than what you purchased it for within 1 year, that's known as a capital gain, or rather a short-term capital gain. Now, if you purchase an asset and sell it for a gain more than 1 year and 1 day, that's what's known as a long-term capital gain. And the difference in these two is the way they are taxed. Now, before we get on that, a capital gain basically applies to things like mutual funds, stocks, bonds, ETFs or exchange traded funds, property, real estate, and even things like Bitcoin. And there's a couple exceptions, but we're not going to get into that, and that's kind of beyond the scope of this video and blog post. But to go back to the short-term and long-term capital gains, when you have a short-term capital gain, that's taxed at your ordinary income rate, whereas a long-term capital gain receives more favorable tax rates. And that's, for most of you, going to be taxed at 15%, but it could be as low as 0% or as high as 20%. So that's kind of the difference in the taxes behind long-term and short-term capital gains. But what are some ways that you can potentially reduce your taxes and pay less money to Uncle Sam? Well, in the blog post below, you can check it out, and it goes into more detail about what I'm talking about. But I've listed 6 strategies for you to think about that you can potentially implement that can reduce your tax burden if you have capital gains. And those are things like tax loss harvesting, where you strategically take losses to reduce your capital gains or income. Tax gain harvesting, where you can potentially take gains in a 0% bracket. You could invest in tax advantage accounts that don't incur capital gains tax, and they're kind of a shelter from taxes especially. You can use an asset location strategy, where that's just a fancy word for putting the assets in the right type of accounts to increase your after-tax return. You can also rebalance across all accounts instead of just your IRAs and tax advantage accounts. You can look at the allocation between your taxable and tax advantage accounts to where maybe you only have to rebalance in the tax advantaged account or IRA, 401k, or Roth to bring your total asset allocation back to normal without actually touching the taxable account and getting some kind of tax liability or capital gain. And lastly, you can hold long term, meaning the longer you hold a position in a taxable account, that just defers that capital gain into the future, and you'll pay taxes on it when you eventually sell it, or capital gains tax rather. So you can check out the blog post below that goes into more detail about these strategies, what capital gains are, and the mechanics behind them. If you have any questions, please reach out. Happy to answer them, and I hope this was helpful.